Hi everyone, it's David from Aventine here to once again walk you through our quarterly market thoughts and our outlook. Now, we named this presentation "The More Things Change, the More They Stay the Same" in reference to the stubbornly high inflation we're still witnessing in combination with the strong employment figures which keep central banks steady on their tightening path. As usual, we like to start the presentation with the year-to-date risk asset performance metrics. And as we can see, the correlation between nearly all asset classes continues. In fact, more recently, what we've begun to see is that some segments, like larger cap stocks, have actually accelerated their decline to catch up to the riskier, smaller cap stocks, which is often what you see in steep bear markets. When represented a different way, we can really see how unprecedented 2022 has been. This inflationary bear market has meant that stocks and bonds do not possess any diversification effects. This has been the worst year on record for a portfolio of stocks and bonds, which we can see here on the right. The graph shows the S&P 500 index performance on the x-axis and the Bloomberg US bond aggregate performance on the y-axis. And we can see that going back to 1989, a portfolio of both stocks and bonds has never seen such negative performance in combination. The result has been a significant de-risking across institutional portfolios. On the right here, we can see that asset allocation to global stocks is in fact at an all-time low. Part of this is due to performance, but part is due to the outlook for corporate earnings deteriorating. 92% of institutional managers expect profits to decline in 2023. In fact, a recent survey of institutional fund managers pointed out that a recession is now widely accepted, with over 60% of the respondents saying a recession was likely. Perhaps even more impressive than the equity market positioning is that of treasuries. Positioning in the treasury market is nearly 3 full standard deviations away from its mean, and at a significant all-time low. To put this into context, here we graphically represent 70 years of treasury market performance across different durations. This shows the unprecedented magnitude of the decline, and it can be seen that the government bond market performance so far this year is far worse than in the 70s. Looking at the bond and equity market together, here we can see that never in history have the returns of long-term treasuries, the notorious risk-off asset, eclipsed those of equities in a down market. So far this year, they have. Corporate bonds are suffering as well. Many investors think that when they buy corporate bonds, they're only getting exposure to credit spreads. But in fact, you're taking on a combination of interest rate and duration risk and credit spreads. While the negative performance in the corporate bond market is partly due to weakening profitability and liquidity, it's mainly due to increasing rates. It is not just the corporate and government bond markets that are related, but the stock market and bond markets are also related. Here, we can see that when we compare the earnings yield of the S&P 500 to the 10-year nominal treasury rate, stocks still appear very expensive in relation to government bonds, and it may continue to be, especially if earnings decline. We see something similar when we compare the dividend yield and the 2-year nominal treasury rate, which is at its lowest rate since 2007, once again showing that the stock market might be overvalued when comparing to the government bond market. The S&P 500 also looks richly valued when we look at the absolute level of inflation. In fact, at the current level of CPI, historical data suggests that the market PE should be just over 11 times. At the end of Q3, it was just over 18 times. But there are signs that inflation should begin to cool soon. First, supply chain constraints have all but disappeared since their peak during COVID. Also, oil and natural gas prices have been moderating, which should translate into lower costs for refined products such as gasoline and jet fuel, thereby lowering transport CPI as well. Similarly, lumber has returned to its pre-COVID average price level. While this is partly due to recession expectations, the results should certainly be a reduction in construction costs. New vehicle prices have significantly decoupled from auto inventories. This relationship is very well established, and it should be pointing to a significant reduction in new car prices within the next year. However, the largest components of CPI remain housing and food costs, and we need progress here to really break the upward trend in inflation. Fortunately, U.S. home prices, as measured by the Schiller National Home Price Index, fell for the first time in the third quarter since December of 2011. Similarly, it appears as if rents have finally broken the trend and are beginning to decline. Rents in the U.S. fell 0.2% in September, which was the first decline this year, and it moved the year-over-year increase down to 7.5%, which is the slowest growth rate since May 2021. As we can see, the growth rate is declining rapidly, with a good sign of things to come. Unfortunately, food prices can be much more volatile and are often subject to geopolitical risk. As we can see, wheat prices have been steadily increasing lately as the rhetoric surrounding the war in Ukraine becomes more unstable. While CPI remains elevated, there is no doubt that the actions of central banks are having an impact on consumer demand. This cycle, the Federal Reserve is hiking rates further and perhaps most importantly, faster than ever before. One important impact of this policy stance has been the reduction of liquidity in financial markets. If we use global money supply as a proxy for liquidity, we can see that it's rapidly retreating, taking the S&P 500 with it. This in itself has important implications for CPI. As we have said in previous presentations, money supply is highly correlated to inflation over the medium term. Given this relationship, we would expect a reduction in core inflation in the next 12 months. Another second-order result of these rapid and dramatic shifts in policy has been the near-record increase in the value of the US dollar. Currently, the US dollar, as measured by the DXY index, is at levels which normally leads to significant economic stress in global economies. However, central banks appear happy to trade economic stress for progress on inflation. We believe that only three things could cause the Federal Reserve to pivot from their current policy. 1, a reduction in inflation. 2, a freezing in the credit markets. Or 3, a dramatic increase in unemployment. We believe that the employment situation is nearing an inflection point, yet unemployment is currently stubbornly low. However, there are signs that the employment market is getting more fragile. If there really was no slack in the labor market, we wouldn't expect real wages to be falling. However, corrected for inflation, real average hourly pay fell 2.1% in August. This could be due to many employers being reluctant to cut staff, even as the economy slips, on concern that they will not be able to hire them back when things turn around. This, in turn, creates weakness in productivity growth, as the same number of workers produce less output. In the first quarter, output per hour worked fell at a 7.4% annual rate and by 4.1% in the second quarter. When we look ahead at employment market leading indicators, the potential outcomes become more severe. Hiring plans have collapsed recently, and these traditionally lead non-farm payrolls by approximately 5 months. This data suggests a steep reduction in employment early next year. While this would certainly increase the odds of a steep recession, it would also all but guarantee a reduction in the Fed policy rate, as consumer debt rose to an all-time high for households among the bottom 90% of the wealth distribution. As a result, the market is still predicting that this is the likely path. Currently, the market is predicting that the Federal Reserve will have to cut rates by 22.5 basis points in 2023, down from an expected 80 basis point cut during the summer market rally in July. The fear remains that without, at a bare minimum, a pause by central banks, real asset prices could be in for a prolonged period of declines, similar to what we saw in the late 1970s and other crisis periods. The bond market certainly agrees with this take, with the recession predictor curve, or the difference between the 10-year and the 2-year government bond yield, still firmly planted in negative territory. What is interesting is that certain central banks have already pivoted due to financial market stress. Earlier this month, the Bank of England was forced to step in and buy long-dated gilts in order to prevent a market collapse, as domestic pension funds were being forced to sell these securities at fire sale prices due to liquidity concerns. One area of optimism is that we are already seeing the dramatic impact central bank actions are having on inflation expectations. As we can see from the chart, the market's expectations of future inflation in 1, 3, and 5 years are all down dramatically. This, in turn, has led to a slight recovery in small business optimism, a potential very good sign of things to come. Finally, in another sign that sentiment may be bottoming, in the first week of October, banks noted that clients were reallocating to equities. In fact, the data showed the third largest net inflow into equities since the data began to be tracked in 2008, with institutions being the largest buyers. Okay, so let's put it all together. Asset markets have continued their significant decline in the third quarter and remain near their year-to-date lows. Investors have responded by slashing risk exposure and raising cash, with risk asset exposures remaining at multi-year lows. Inflation remains front and center in the mind of investors and is seen as the biggest risk to markets. Central banks are intent on staying the course until inflation is reduced, credit markets freeze, or employment suffers. Unemployment remains at historically low levels, providing central banks cover for their actions. However, some forward-looking data suggests this may inflect shortly. Interestingly, certain central banks, like the Bank of England, have already pivoted due to stress in their bond markets. Recently, we have noted that small business sentiment has ticked upwards, and investors seem to be adding to equity exposure, suggesting a potential near-term bottom in risk asset prices. I think I'd like to add one other point here. As can be seen in the presentation, we're in a very uncertain time. However, markets often front-run economic activity, and with positioning at multi-generational lows and extremely negative expectations, even a marginal improvement in the data could mark a significant turning point and subsequent market rally. I want to thank you all for listening to the presentation, and as always, please do not hesitate to reach out if you have any questions or if you'd like to discuss anything further. Thanks again.